Well, it is increasingly looking like a piecemeal approach for Congress. Lawmakers reportedly considering a 1-week spending bill to keep the government open so they can find some kind of resolution on the coronavirus stimulus, along with other bills they are looking at right now. Let's bring in Ben Mandel. He is JPMorgan Asset Management Global Strategist. Ben, just walk me through some of your thesis right now as you look to Washington to see if there is going to be any kind of stimulus. It feels like regardless of what is passed, it's not going to have a significant move in the markets because it is expected to be a bridge to January when we've got the incoming administration. How are you viewing these discussions right now?
Well, I think to put it into context of the macro outlook, as we look at the next 12 months, it's really the story of two halves. There's a journey and a destination. The destination is a wonderful place in the sense that when we're on the other side of the vaccine coming out, you'll have segments of the economy that are reviving after a period of laying dormant. You'll have the output gap in the economy, which will be in the vicinity of closed. And that will truly be the capstone of the early cycle phase of this expansion. And so we have a lot of conviction in that happening, not just because of the light at the end of the tunnel via the vaccine, but you've also seen a very rapid recovery so far, limited evidence of scarring in the economy. And that kind of underpins a fairly sanguine view on a 12-month outlook. The risk really is the journey. It's how do we get there? And it's not necessarily going to be a linear path from here to there. We have penciled in already a slight deceleration in the first quarter of the year. And it's not unreasonable if that were to turn, if things get worse, into a double dip for US growth in line with the type of double dip you're seeing right now in the Euro area and the UK. And so I think where fiscal and where monetary policy enter is as a hedge against that downside risk to ward off the probability of that double dip, not recession, but double dip in GDP growth in the US. We haven't penciled into our outlook as yet, so it would represent some upside there. But as I said, it's really not about the upside; it's about warding off the downside.
Yeah, and I mean, Ben, when you talk about limited evidence of economic scarring, I mean, we've seen on the permanent unemployment front that has moved down quicker than what we saw back in the Great Recession. Obviously, it seems like things are kind of taking a stall right now. But how much of your expectations in that not continuing to be worse than what we saw back then hinges on getting another stimulus bill through and if so, and what timeline would you want to see that to prevent the further scarring you're talking about?
Well, I don't think it's totally necessary. In our baseline outlook, we have growth in the U.S. that's positive this quarter. Keep in mind, we're in December. We've already seen a lot of what's going to happen there. So the risk of a double dip on a quarterly basis is very limited right now. In the first quarter of next year, we have a modestly positive growth rate for the U.S. economy, but that's kind of where the fragility lies. And we're looking at a few things. One is the restrictions themselves. On a state-by-state basis, it's fair to say there's been a broad tightening of COVID-related restrictions, but the delta on those restrictions is not as much as it was earlier in the year. Earlier in the year, we went from 0 restrictions to lockdown. Here, we're going from partial lockdown to partial lockdown, so it's not going to be as onerous for growth as it was before. So that's the risk, obviously, that the trend continues in terms of tightening. We just don't expect it to be as damaging as it was before. We're also looking, to your point, on the labor market. What are the trends there? And we look at the different flows, the flows from employment to unemployment, through things like the jobless claims, but also the flows back into employment from unemployment and the flows into the labor force from out of the labor force. So the one you mentioned is one example of that, people who are unemployed for a long time, giving up and exiting the workforce. And there, as you look very holistically across all those different labor market flows, the picture is one where the progress is going to be much flatter over the next few months than it was over the previous few months. So the unemployment rate coming down last month to 6.5%, I'm sorry, to 6.7% from 6.9, that small gap, the small improvement is indicative of that relatively slow progression there. And so what does that mean from a household income perspective? you have a slightly less aggressive support via the labor market. And that puts a lot of the incidence on the household savings that have accumulated over the last few months. It's a fairly large cash pile when you add it up because household saving rates have been very high. And when you put it all together cumulatively, you're getting something on the order of 8% of US GDP sitting there as excess savings on household balance sheets. So therein lies the risk as well. If you do get more aggressive restrictions from the virus, if you do get less progress in the labor market, you're probably also going to get household precautionary savings that start to rise as well. And that cash pile is not really spent out as quickly or as ambitiously as we'd think.
Ben, you alluded to some of the stay-at-home restrictions that we're seeing reimposed now in a number of states on a very stringent level, certainly not to the level that we saw early on in the pandemic, but the most significant we've seen since then. That would seem to suggest that the kind of declines we saw in a March or April, sure, maybe not on the same level, but there is likely a big hit waiting on the other end of this most recent wave. As Washington tries to figure out what to do on this front, what do you see as the role of the Fed to steer this wave or the economic hit from this wave this time around, given just how big they went in the first wave?
Yeah, I mean, I agree that monetary policy is very much part of the solution as well, whether or you do get fiscal or you don't, in the sense that they're very attuned to the downside risks associated with this wave of the virus, and are likely to try to get ahead of that starting at the meeting next week. You've already had a collection of developed market central banks who have enhanced their quantitative easing in response to this wave of the virus. We're expecting some modifications to the Fed's asset purchase program next week. We're expecting some qualitative guidance on how long those asset purchases are going to take place. But the idea is that financial conditions writ large are likely to stay highly accommodative as a result of those downside risks. It does seem somewhat counterintuitive that you'd get the Fed actually easing policy after one of the best growth quarters in history in Q3. But that's exactly where we are. This virus is one of ebbs and flows in economic growth, and the downside risk in Q1 is one that has surely not escaped the view of the Fed.
Yeah, and that's something that we've heard from Fed Chair Powell numerous times in terms of having to get a handle on the virus itself before you see that sustained recovery. Ben Mandel, JPMorgan asset management global strategist, appreciate you coming on here to chat today.